Now, before we begin this segment, we'd like to remind you, please like, share, subscribe, especially sharing, your support is appreciated. So now that when we look at just the weekly data, we like to look at not only what happened weekly, but also the 4-week rolling average. And this looks at gasoline, jet, disti, and resid to look at, those essentially the demand, the economic drivers, what's happening on the road, what's happening in industrials. So the current is at 14.204 million. Versus last week, which was the high of 14.568 million. And right now that's putting us at an average of about 14.288. So here you can see, again, that kind of flatlining. And this is something where we think we're going to get a little bit more of a pullback. Distillate will give us a little bit of a bump to the upside, gasoline a little bit of a decline, and we should average out. So as we go into next week, I don't see a huge drop. If anything, it's just kind of sideways. We will get a slow trend or a slow bleed to about 14 million, maybe 13.9 million barrels a day. But again, we're not going to get a huge surge to the upside, not a huge surge to the downside. We're just going to kind of go flat. And the one thing that I always like to stress is we are in reopening. This isn't like we're going to reopen. We're in the reopening process. And that's why I just want to preface that as we look at what does demand look like right now in a reopening situation? How is that being mitigated in terms of some of the demand? Where is that being supportive of demand? Because again, this isn't a thing to come, it's happening. So this is why we always want to look at, okay, well, as it's happening, is it accelerating, decelerating, or just kind of going flat? And that's why we think at this point, as people continue to get vaccinated, we're going to continue to see this flat line just without much going on, because we still believe that jet demand is going to remain at a steady state where it currently is. And we'll talk about where that is in a minute, where it's actually almost at a perfect average between 2019 and 2020. But when we look at in general, we still think people are going to stay local or more local than 2019, obviously less local than 2020. But that's going to cap and keep us from getting back to these normal levels of 17, 18, and 19, which you can see they're clustered around in general. So then when we look at distillate specifically, just start with disti as we like to. Distillate fell by about 1 million barrels in storage. Still about 5.5 million over the year over year, but 2.9 million over that 5-year average. So you're seeing some of that elevation in general. We typically get those draws that start to reverse. Imports, as we were saying, they're going to continue to fall. They'll still remain slightly above average, as we see that they're 56,000 above year over year, 38,000 above the 5-year average. But the disti imports or diesel imports are going to continue to trend down just because the arbitrage is closed. Things are getting a little bit better in the UK. That's going to be supportive of some of that activity. So and just keep some of that distillate out of the U.S. market. But at the same time, they're also not importing anything from the U.S., so our exports are going to continue to struggle. So our imports are going to be flat to down, exports are going to be down, and then but when we look at what a refiner is looking to target, they continue to target the gasoline side, not so much the distillate side. So we'll continue to see some of the distillate stocks come down, and that gasoline being the bigger focus. Now, gasoline and diesel flows to the U.S., the diesel's coming down, gasoline's starting to rise, but we'll talk about the distillate side, the gasoline side in a bit more detail in a minute. So when we take what's happened with distillate storage, we want to look at what is happening on the demand side. So here you can see we're pulled back a little bit. Still remain above the 5-year average, which makes sense if you consider where we are in terms of trucking. Trucking remains very strong, especially given some of the shortages. And even we're coming out of the typical slow period, which is March into April, and then things typically accelerate in May, but we never really saw that real big dip. We will get a little bit of a bump from the heating oil side, just given some of that residual cold that came through large parts of not only the Midwest but the Northeast. And that will be supportive over the next week or so as some of those movements happen. But then again, that'll start to pare back as well. And as we look at just truck stop, here you can see just we still remain very strong. Load availability is going back to the highs as again companies are struggling to just get stuff into the market. Procter Gamble came out and said that they're going to raise prices about mid to upper single digits. To me, that's 7 to 8%. They're expected to roll all of that out by the end, but be fully completed and increased by September. Everything including diapers, feminine products, and other. They obviously produce Tide and a lot of those other household items. So again, just showing that the companies are finally starting to push through more of those prices, which again, for anybody who's ever bought diapers, they're already expensive and they're not getting cheaper. So but again, this is just a big driver of that is the amount of trucking that is demanded, the amount of flow through that's going to continue. And when we look at diesel continues to be fairly stable, and we'll talk about that in a minute. But when we look at the year over year, obviously the base effect is there. But here you can see that the demand is remaining strong, which is again going to pull up some of these rates, especially as we have contracts rolling off. And typically contracts will go off of spot or some average of spot, which will again pull the average rate higher. So when we look at rail, when we look at the base effect in general, it's continuing to move higher. But when we look at guidance, guidance still remains fairly strong. We did get some of the earnings starting up. They missed estimates in Q1, but their expectations that we're going to start to see some of those missed estimates reverse, and Q2 will be stronger, just given the amount of new capacity that needs to come into the market to just again moving these cargoes from the coast into the all parts of the U.S. really. So then when we look at total carloads, they're up versus 2020, which isn't a big surprise, but you can see that we're continuously moving higher. Motor vehicle and parts are starting to have some positive moves, even once we back out some of the base effect, just because we do have some of the acceleration in just manufacturing on the car side. And then grains is going to remain strong, little to adjust in that, and intermodal continues to run elevated. I mean, obviously when we take out that large base effect, we'd still have a very strong movement on the intermodal side, now in the lower double digits, and that should continue to drift up as obviously trucking gets more expensive and guys are looking to normalize their supply chains in greater quantities. It's much easier to have 100 carloads show up than just one truck. So again, these are things that are going to continue to be a bullish side for the distillate. Then when we look at the indexes coming into the West Coast, we remain very strong, well over where we should be at this point in time. You can see that the movements are coming in, and there's still that backlog. So far, the commentaries and the movements on the Teamsters longshoreman side on a potential strike has abated a bit, but it's still there. There's still that concern that we're going to get more disruptions as people are looking at this saying, look, I'm overworked. I'm trying to do more. You need to pay me more or we're not going to do anything. And I think we're starting to see those friction points, not only in the emerging markets, but also happening in the developed world as well. Now, rounding it out, this is what we're talking about when we're seeing a little bit of a warm up. The South and Midwest is getting a bit warmer as we go forward. It's slightly above average, but still close to average. So as you just think about where we normally in April and May, it'll be enjoyable, mid 60s, if you will. So, it's just going to limit the amount that people are turning on their heat. You might have it click on once or twice in the middle of the night as things get a bit colder. But again, you're just seeing that we're essentially at the end of that after that residual cold has now abated, and now we're going to start getting back to a bit of a normal side. When we look at gasoline stocks, we had a build of 90,000 barrels, so pretty much nothing. It was pretty much balanced out by Pad 1. Pad 3 had a 950,000 barrel a day, the 950,000 barrel draw. Pad 1 had a build of 1.22 million. So everyone, and this is why I don't get too hyped up about specific pads, because especially when you're on the coast, because the floating market has a way to fix that. And that happened in Pad 1. So Pad 1 went from having this huge draw, these huge levels, and now we're back to essentially flat against the 5-year average. We're still about 800,000 barrels below the 5-year, but again, that's much tighter than where it was. And you can see why when we look at imports. Imports were up 376,000 barrels in Pad 1, which is 582,000 against year over year, 302,000 against the 5-year. And that's what I was saying last week. We thought we were going to get more of an imports. There was a big backlog in New York Harbor. Some of those guys left and went into other harbors, which is why we said that we were going to get a big surge this week. And here it is. It'll pare back from this week, but it'll still remain elevated in general, because when we look at the 5-year average on all of the U.S., we were up 344,000. So again, that's going to remain elevated. Cargoes came into pretty much all the pads in general. Pad 1 and Pad 3 saw the largest. Pad 5 saw a decline. It's still up in general, but again, Pad 5 is going to see another increase based on what we said, with about 490,000 tons coming from the Asia into the West Coast, and we do have more flows coming into Pad 1. So European oil product shipments to the U.S. Should drop month over month, though. Now, the reason why they're going to drop is if they leave in March, they show up in April. So obviously that can vary depending on when in March. But right now, the new cycle is slowing down a bit. So that means that as we get into May, we're going to start to see some of these imports drop, and we're going to start to see a little bit of a balancing. Now, that could accelerate depending on where it is, but as stockpiles start to flatline, we're getting some of the margin eroding a bit, which is just putting a bit of pressure on what is that break-even number and what that arbitrage looks like. So right now, about 3.05 million tons, mostly gasoline and blending components, are expected to be shipped from Europe to the Americas this month, which includes 55 tankers that have sailed with 2 million tons, with another 25 ships with about 1 million ready to, still to go. A few more cargoes will likely emerge over the next, let's call it 10 days. And then shipments look likely to be less than the 4.54 million tons that left in March. Instead, we'll be closer to about, by the end of all of this, we'll be at about 3.5. So we'll be about 1 million below where we were in March for April. But again, we're still going to see a lot of that elevation, as we talked about, versus what we've seen in general. And also at the same time, March was the largest we've seen since April of 2019. European flows to the U.S. have been about 1.26 million so far in April, compared with the 2.67 in all of March. So again, you're starting to see that slow down a bit, which is coming through, but we're still going to remain elevated in general. And when you think about why, well, you have the yield shifting. So the U.S. refiners targeted gasoline by another 1.5%. Right now, we're about maxed. So we're at about without taking refinery utilizations higher, we really can't create more gasoline. We would have to either take the only way to increase gasoline throughput at this point is to take refinery utilization rates higher, which, given what's still expected to come from imports, there's really no reason to do that. But here you can see against the 29-year average, you can see that we normally get this drop. And instead, as we were saying last week, we expected a flat line where demand is still remaining fairly strong, but those imports are going to keep us capped, and exports will remain low. They came in a little bit higher than expected this week, but that's something that we think is a bit more of a timing side. Now, when we talk about that slowdown, I think Gas Buddy does a great job of showing how, look, we're not going to collapse. This isn't we're going to see gasoline demand disappear. It's just it's slowing. It's coming back a little bit. So according to Gas Buddy data, Saturday U.S. gasoline demand rose 2.1% from the prior Saturday, closing the week with a 0.7% decline in weekly gasoline demand. It's the second straight week of weekly declines. Now, let's put that into context. So according to Gas Buddy data, Monday U.S. gasoline demand fell 2.1% from the prior Monday, with Tuesday demand was down 3.5% from the prior Tuesday. So we're still seeing that midweek pressure, but then Saturday and Sundays continue to get a little bit better, which is, again, the balance that we're seeing, where we're getting some of that slowdown on the weekday, and then the weekend is getting some of that strength, which, again, is going to keep us a little bit below the high that we saw from Easter weekend. But again, just that plateau, which is why we think we get a little bit of that pullback on the EIA side, because this is going to be that timing delay we talk about. So demand so far this week looks to drop for a third straight week as it stands down 1.6% week to date through Tuesday. So again, that's Sunday, Monday, Tuesday. We should maintain that, and then I'm expecting that same pop on Saturday, which will again mitigate some of this, but we should be down 0.5%, 1% to about 0.5%, depending on what happens in general. And then when we look at Descartes Lab, they saw we increased less than 1%. They have us at 9.4. That's why it's just a matter of marrying kind of where we sit. Based on the aggregate data we look at, we're between about that 8.9 to 9, which is why we think we get a little bit of that drawdown. But again, nothing crazy in general. So then what is that? What is driving that? Well, when we look at the year ago, you can see the base effect. But when we look at the week-on-week change, it's fairly flattish. For this week, we're pushing a little bit higher. We should come in at about 2.87 by the time we get to next week. So again, kind of that slow move, but nothing crazy. I mean, this is where we were in 2019. So we're not getting too much of a shift in general. And then as we get into the summer driving, that'll get shifted up again. On the diesel side, as we were saying last week, we don't see much change right now because everything is fairly flattish. As the demand for diesel starts to push higher for trucking this week, maybe we get, half a penny back up, which essentially just takes away the small drop. But 312 to 313 is kind of the ballpark that we're seeing over the next few weeks. But on the blending component side, this is where it gets interesting. We continue to make more blending components. We imported a bit more. This is where the refiners are able to try to make some of those movements. So when we look at, just coming back to the segment one, when we saw runs going down, utilization rate staying flat, but oil runs coming down. Well, you can utilize your facility a little bit differently. So you don't need new crude. You can take some of this so you can be making blending components. So when we look at blending components in general, blending components, even though gasoline only built 90,000 barrels, blending components built 1.13 million. So again, we're closing some of that gap. So gasoline versus the 5-year is still down 6.3 million, but blending components on the 5-year is down 3.2 million. So again, the focus is shifted. Let's make summer grade. So they're making more of that blending. So this is where we could see some of this slowdown when we get into the summer months, just because they're already looking to target that gasoline side. So then when we look against the 15-year average, we had that nice little spike up, that little check mark, if you will. This is that residual that we were talking about. I thought last week we saw the remainder of the residual. Clearly, I was wrong. Here is the kind of that last push. And not that we're going to get this huge drop, but it's just we're going to see a little bit of this normalization to the downside and start to just go a little bit flatter as we go through the next few weeks. Now, when we go back over the last few years, we're right at 2018. So you can see that 2018 had this big drop. We came up to kiss it right here. And now, again, we're going to get a little bit of a normalization and then up that flat line in general that we continue to talk about. We'll probably come back to, we'll still make a higher low. And it's just we're not going to get this big walk back, but we're just going to get some of this normalization as the supply chain balances itself out. So again, it's still a net positive in general. It's just we have to look at this on a seasonal aspect where we get the move up. We had some residual spring breaks depending on where you are. We had a little bit of the inclement weather that paired things back a touch. Now we'll start to see some of this flat line, and then we'll start to see another move up as we go into the summer months. So that's why we're looking at April. The rest of April will be down, slightly down. First week of May will be slightly, flattish, and then we'll start to see some of those creeping up as we get into Memorial Day, as we normally do on a seasonal level. Then when we look at propane had a draw of 70,000 barrels. Again, we're just following essentially 2017, and we're going to start to turn up here. But we're just flattening out because implied demand was down, but exports are up. And just based on what we're seeing in the market, exports will remain strong, but implied demand is going to, again, move closer to the seasonal norm. Now, the other side, when we look at just U.S. activity in general, new COVID deaths are moving in the right direction. We're starting to see that decline considerably, which is obviously a net positive. But we are seeing cases start increase, but again, they're not above 500,000. We've essentially hit that flat line or that plateau, and it'll continue to get whittled down as more vaccines increase, as people just are exposed to it, and then they have their immunities. So again, we're going to start to see some of that those benefits, but it's not going to be a precipitous drop or this huge increase. It's just going to be this flat line, which again is going to keep some of this friction, especially as we have the restrictions remaining on international travel. Then when we look at some of the activity throughout the week, you can see the drop in parks, again, speaking to some of the inclement weather that we had over the weekend. That just essentially pulled us down a bit. That's going to continue to go up. One of the things that we keep talking about is we're not going to get air travel the same way as we had in 2019. It'll clearly be better than 2020, but we will have people going to parks, doing things more locally, which again is that shift between weekday, weekend movements. As workplace still remains flat, transit stations are flat, as we see just everything kind of now hitting its stride when we look at those normalcies. The question will be what happens in September through November, as that is when a lot of companies are slated to either have employees come back or start to see some of these shifts in general. So I think as we get into the end of the summer, we're going to have to make a decision on, or at least from the company's perspective, where do we see gasoline going? How are people taking to going back to the office? Is some of that delayed? So that'll be an interesting time. But right now, we're still going to look at and follow the seasonal trends, just at a slight at a slightly lower level than normal. So then when we look at Apple in general, here's again, the same thing that we've been saying. We're just kind of going flat here. And that's where we continue to see some of these headwinds. Now, the UK is back above the that level. We're at about a little bit above the baseline, but then Germany and Italy again remain on that flattish level. We're not really seeing these spikes. If anything, we're seeing spikes to the downside, and the toll road data continues to show those pressures that remain in not only Italy but also in France and Germany. Now, when we look at it at vaccines administered, the U.S. pared back a little bit. We're still at a 0.9. Last week, we were at 1.01. So we're still within that comfortable range. Germany has picked it up a bit, same with France, but still a little too slow than I think what people would like. And the same can be said about India. Again, these are those three key locations that we're looking at to see what does that activity look like and when do we get some of this acceleration, because we're just not seeing this movement. And now with some of these levels of vaccine deliveries getting cut, that's again going to weigh. Now, when we look at jet fuel had a build of 500,000 barrels. It did what we were saying. It made a lower low, but not a huge one. Maybe we see another 176,000 barrels get shaved off of the demand number, but between this million to 1.2 is going to be kind of this comfortable level as we go through, not only just the remainder of April, but also into May, just based on the data that we're seeing, where we're just seeing this marked shift to the downside. And here's where, it's not just the U.S. The North America has seen the flat line. We're not really doing much up or down. Asia Pacific is starting to roll over a bit. That is something that's going to continue. And the same with the rest of the world and Europe coming down a bit. So the average number of departures per day decreased 620 week on week. Year-on-year departures obviously grew, but the U.S., India, and Turkey led declines while Australia led the growth. Australia obviously opened back up with New Zealand. That's going to increase, but U.S., India. U.S. is just going to be seasonal right now. So it'll be below, but it'll be a seasonal move, where India is the one that's going to continue to see some of the pressure. Now, the airline industry is set to lose 47 to 48 billion in 2021, according to the new estimates from the IATA, which is weaker than the forecast, which was initially 38 billion, which is really being driven by the resurgence of COVID in some of these key areas, which is just going to hinder that global travel, international travel. So the airline forecast 2021 global air traffic at 43% of pre-crisis levels versus 51% initially forecasted in December. So again, there's a bit of a mix in there. We still see, or at least Europe is still targeting an increase in June, which would be a net positive. But again, we're still at that flatline level, which when we look at just TSA passengers, and here's where this is what we were saying. We were just going to split the difference. We're not going to be at 2020 lows. We're not going to be at 2019 highs. We're going to be at a deviation down. And here's where you can see we're just working within the average. So I normally take the average out, but I wanted to leave it in because you can see that we're tracking it pretty well. Obviously, we're going to the upside in different areas with in general, but right now we're between, again, that our levels of 1 million to 1.3 is where we're averaging. And it's an average because we are getting spikes to 1.5. We are getting spikes to right to 1 million. So that 1.3 is kind of where we're sitting in general, and that's where you can see us, the top end of this range. But again, as we go into June, we saw it in 2020, we see it in 2019. We normally get more people traveling for the summer. So when it does come, because it will, it's not going to be this huge surge like we're getting back to normal. It's going to be where are we versus seasonal norms, and that's going to be something to watch as we get to those levels. And then, a webinar poll from TS Lombard, showed where do you see business travel versus pre-COVID levels. People are saying anywhere between 50% and 75%, which I think for me, if I was voting, I'd say 50%, just because people, I know personally, individuals that were traveling 4 days a week, 3 weeks out of the month are now flying 4 days a week, 1 week a month. So we're getting a little bit, you're still going to do the face-to-face. It's just not going to be at the same frequency, but you still can't replace that face-to-face interaction. So you're still going to get it. It's just going to be a matter of how frequent will it be. And that's where I would fall on that level. Now on the open table side, again, we had weather coming in. We had some of those issues in general, but we still are hanging within this kind of comfort range of 33% versus normal. Here on the global level, you can see, some of those spikes in general down. Again, looking at the U.S., speaking to some of the weather in general, but we're still seeing those steady levels of 35 to 28 to 20%. Australia's moderated a bit, but Canada's back in a lockdown, which obviously is going to pull down the average. Germany's remaining, Ireland's remaining, UK is starting to open back up. So the UK should offset Canada as we start to see some of this normalcy, and that's going to keep us at a 35% or so below normal as we go through the just activity. So that's where, again, there's some positives in there, but we just have to be cognizant of where is refinery throughput, where is demand, and we just see those headwinds coming into it. Again, not headwinds that are going to pull us to these lows, but that are just going to cap us to the upside as we go through the remainder of April and into the middle of May.